I'm going to be talking about how do we protect our estate from things such as taxes. And in my opinion, the number one new estate tax is actually not the estate tax that everybody knows. It is the income tax. See, most of us have saved at this point more money into our IRAs, our 401ks, our 403bs than we might even have equity in our house, depending on how much of a mortgage you have or don't have. And the vast majority of our savings is saved into these tax-deferred accounts. Now, some of you out there might be saying, well, I have a Roth account. Yes, but usually a Roth is a smaller portion of your savings. The larger portion of your savings is still in that tax-deferred account. And the problem with this is that when you have a lot of money in a tax-deferred account, at some point the IRS is going to come calling. They're going to come calling from you, your spouse, your beneficiaries, whether it's your children or other beneficiaries. They will come calling for that money. And when we've saved most of our money there, and now all of a sudden we're going to have all of these taxes due, how do we start protecting it as it pertains to estate planning topics that I've talked about in other shows? So the different things that I want to talk about today are, and the stories that I've used and the silly names that I use are, how do we protect from Biff or Bambi? So one of us passes away, how do we protect our spouse from remarriage risk or from other risks after we've passed away and we left these assets to our spouse? Or what about when we leave it to our children or our grandchildren? How do we protect it for them? And then also, how do we protect it from your long-term care issues if you were to have them during your life? See, if you got a lot of money in these tax-deferred accounts, it changes the game in which we have to play with. So I want to start with, how do we do protections for our spouse? I've said the statistics before. The statistics say that anywhere between 50% of us will be divorced at some point in our life. Well, that's not what I'm talking about. I'm talking about one of us passes away and we leave the assets to our spouse, and then they might meet someone new, right? I had somebody 91 and 86 get married here in the last couple of years. I know a lot of people out there say, I'm not going to do this, I'm not going to get remarried, I'm too old to be remarried, whatever your reasons might be. I don't disagree with you, but that doesn't mean that we shouldn't consider how to protect the IRA money that may be being passed between spouses. See, because usually the suggestion would be that when you have a large amount of IRA money, that you leave it directly to your spouse. The reason that you would leave it directly to your spouse is so that they receive it. And there are some tax reasons for them to receive it. See, let's say you have a spouse that's 80 and their spouse is 75. Well, if the 80-year-old passes away and we roll the IRA that they had over to their spouse, it is now taxed at the 75-year-old's required minimum distribution level. So there are some tax reasons, because you can't do this when you leave it to a non-spouse beneficiary, i.e. a child. And I'll talk about that here coming up. But if you leave it directly to your spouse, there's some good tax reasons to do so. But taxes are just one portion of this story. Because if I have, let's say, $300,000 in my IRA, and I'm that 80-year-old, and I leave it to my 75-year-old wife, now she has 100% access to that money. She can do whatever she wants to with that money. So back to my Biff and Bambi story. Okay, what if she meets Biff the pool boy? And she wants to either cohabitate, marry, whatever it might be with Biff the pool boy. How can she use that money with Biff the pool boy? That's right. She can use it however she wants. The only repercussion for how she uses it is potentially taxes. And we'll talk about how those can be worse if we leave it all to her as well. But she can use it however she wants. And so now you have a blended family, right? Or what if you're already in a blended family and you leave all of your IRA money for tax reasons to your spouse? Now it's theirs. What protections do you have for your family? I would argue not nearly as many, right? So let's use two different examples here. We have a first marriage, and then we'll talk about a not first marriage. So the first marriage, you leave it all to your spouse. She or he has all of it. They can go and do whatever they want with it. Well, if they go and they want to be in a new relationship, let's say they don't even get married, could they leave a portion of that to that other individual? And the answer is darn right they can. Or let's say they are married. Now, there's some tax reasons if they were to be the first to die that you would want to leave it to the surviving spouse because of the way you can roll it over. Well, geez, if I leave it to you and then you leave it to your new spouse and that new spouse gets all the tax benefits, but now they don't have any connection to our family or connection to me who earned this money or saved this money during my lifetime, can you see how we might want to protect from that? And I'll talk about how to protect from it here coming up. What about if you leave it to your spouse and now they're single? Let's say they don't even ever meet anybody or they never get married and they don't have any plans to leave it to their new significant other. Well, what if we leave it to them and they're in now a higher tax bracket, right? Now, I don't know how closely you watch the tax brackets. I watch them pretty closely for these kinds of purposes. But let's say that you've got a married couple filing jointly versus a single person. Usually, now not always, but usually the tax brackets are pretty close to half. So if you can make $75,000 as a couple, you're going to make $37,750 as a single person before you go into the same tax brackets. They're usually just kind of cut in half. Well, a lot of times what happens is when one spouse dies, the other spouse not only receives all of the IRA money, they also receive a larger amount of Social Security if the first to die had a higher Social Security amount, or what if that person had a pension, or what if you've done other things like you have rental properties or other things that are creating income on an annual basis for you to help pay your bills. Well, once one person is out of the picture, now the tax brackets could be higher. So now when that spouse has to take the RMDs, the required minimum distributions, because they're over 70 and a half, they may be being taxed at a higher level. Oh, by the way, now they have more money because you just left it to them and they rolled it over into their own name. So let's say they had $100,000 of their own in IRAs, and then you leave them another $300. Now they have $400 to be taxed at their income tax bracket as they take it out or as they're forced to take it out. So what could we potentially be losing? Right, we could be losing money. We could be losing tax money to the IRS rather than for our spouse to keep, or rather than for our family to keep, or rather than for us to go and spend and have the fun or whatever you wanted to do with that savings. So it's one of these deals where it makes some tax sense to leave it to somebody, but kind of my philosophy on it is take some time to assess all of the scenarios, all of the risks, all of the potential things that can happen to this. Because in my opinion, I want to play the game and win as much as I can against Uncle Sam. But if you just keep keeping it in that tax deferred account, you start to lose options, lose choices, lose protections that might otherwise be available to you had you taken a little bit out here, there, or everywhere. So how do we possibly protect this? Well, number one, I want you to talk with your tax person. That's your accountant, your CPA, possibly your financial advisor, possibly your estate attorney. I would always defer to the person that helps you file your taxes. Now you might be saying, well, I file my own taxes. I do TurboTax. Well, it might be worth your while to talk to a CPA who will take a longer look at what we can do to try to protect your estate from tax risk. See, because tax risk, especially with our IRAs, is, in my opinion, the biggest risk. So talk with your tax person. Does it make sense to take $5,000, $10,000, $15,000, $20,000, whatever the number might be, out of your IRAs or your 401ks once you're 259 and a half, start taking out some of that money in little bits and pieces and taking it out of what we call the qualified side and moving it over to the non-qualified side, into something that is not tax deferred, that if you were to invest it and it has earnings, maybe you pay a little bit of tax as it grows. Or maybe you look at tax exempt kind of offerings. I'm not a huge fan of annuities for non-IRA money because it changes the tax game again and becomes an income tax to your beneficiaries when you pass away and you leave that to them. But there are options out there. So this is where you have to have a team working for you. Now, I know that a lot of people out there want to do it themselves. They're do-it-yourselfers. I know the investment's better. I know the tax is better, whatever. But at some point, it does make sense to have, in my opinion, a team. A team being a financial planner who's working and talking to you about how to invest these things in a tax-efficient manner, a CPA that's working with you, and the financial advisor on how to make this work and how to take withdrawals if necessary to try to protect from tax risk. And then it's talking with individuals like us in our office about how do we protect it in your estate for you, your spouse, your kids, etc. And then I think sometimes it makes sense to have what I'll call a blended approach to how you split up your money at your passing. Now, this is not always available. It's only available for those families that you can take a look at the income sources and other resources and say, okay, well, if I die first, my spouse is going to be perfectly okay, even if they don't get all of these monies. If they're not going to be perfectly okay without all of these monies, then I think it may make some sense to leave it to them. But it's worth the conversation. But if they're going to be okay without all of it, does it make sense to start peeling off some of it and not leave it directly to the spouse, or and leave it to the kids or the grandkids at your passing rather than all to your spouse? Yes, that may speed up the taxation of it, but it's going to get taxed either way. But now you can start protecting it from the Biff and the Bambi risk where somebody gets remarried or lives with somebody afterwards. What about long-term care risk? I'm going to talk about that a little bit later. Well, if you leave it all to your spouse and that spouse has a long-term care event after you've passed away, now we have less ability to protect that money, and we may actually end up paying more in taxes, all depending, because of some of the uses that we might have to use that money for, or how fast we might have to pull that money out of the account. So I think that it takes a blended approach to this. It takes talking to your tax person, talking to your financial advisor, talking with your estate attorney such as us. What makes the most sense? Sometimes the default answer or this simple answer may cause more issues or worse issues than you would prefer. And I'm going to just make this blanket statement before I kind of go into break here is, generally speaking, the more that you can protect your estate while you're alive, the more choices you will have about how much Uncle Sam gets. Because once you get sick, once you die, you lose that capability of protecting that way. Because now they're calling the shots. Because now the IRS is saying, okay, these are the rules and you better play by them. So you got to really take a hard look at this. All right, so I want to take a break here, but I want to remind everybody about our workshops. I do educational workshops typically twice a month where I'm talking about how to protect your estate in ways like I'm talking about today, where we're leaving it to you to come and get educated.